Patrick, good to see you.
Yeah, it's great to see you. I mean, I don't think I've seen you since I was saying in person. Now, in person means seeing your face rather than actually being in person. But yeah, I think since like last Christmas maybe. So good to see you. I hope you've kept well in the last over the crazy period that we've had.
Yeah, I mewith usual sort of shenanigans, 3 kids running feral around the house that you probably get from all of the people you know with children. It is a struggle, and hopefully the news is slightly more incrementally better this week. It's one of those, really, isn't it? It's kind of, do you actually still watch the news?
Yeah, that's a great question. Given that, I mean, obviously what Leo and I do means we follow politics pretty closely, but even we have just become, I mean, those 5 o'clock those 5 o'clock sessions, which just are so mind-numbingly like boring, and people ask the same questions about can they go on holiday. It's a real, that grinds you down.
Yeah, I definitely don't watch the Q&A. I'll check in like every couple of times a week, but the day-to-day picture doesn't really change much, but you do want to know like the trend. So
look, thank you for joining us today, Patrick. We're really excited about finding out more about Form, and just as a bit of background for you, I think you're about the 3rd or 4th VC we've had on. Really interesting insights from the previous guests on the show, or as I call them, fund stars, and clearly what we like to do in the sort of 45 minutes that takes the call duration is just have a chat, discuss, ask a few nosy questions, and hopefully come away, as will the audience, with a greater understanding of Form Ventures than they had at the start of the call. So I think that's probably the right approach. And Anthony, I don't know if you've got anything to add to that.
No, I think that's spot on.
Good. And I suppose first question is always the obvious one. Form Ventures, how did you get to Form? What was the previous career? Leo and yourself, were you colleagues in another VC? I'm just curious to sort of understand the driving motivations and how you got to the point of starting Form in the first place.
Sure. So yeah, Leo and I were colleagues, but we weren't colleagues at a VC. We were actually colleagues at CBI, which is the biggest private sector lobby group in the UK. We've known each other for 12 years, worked together in, I think, 3 or 4 different contexts since uni, where we first met. And I guess when we started, so I should say after CBI, we went in different directions. So Leo became special advisor to Vince Cable, so he went into government. I ended up leading the corporate venture fund at Deloitte Ventures, investing Deloitte's partners' money in startups. And back in 2018, Leo and I were catching up over coffee, and we were both remarking on the same thing that we could see in the market, which was a lot of startups very early on at pre-seed, seed, Series A, where they were taking on markets where regulation or policy really matters to that market. They were struggling, basically. Like, large businesses can pay for third-party advisory to come in and help you tackle regulatory or policy issues. But when you're really early on, obviously you don't have the cash flow to do that. So we could see startups were really struggling in those markets, but no fund in the UK or in Europe were basically able to help. At the same time, we could see in the US, Tusk Ventures is a fund like focusing specifically on helping tackle those issues or seize opportunities in that domain. And so in 2018, we thought like, oh, we should explore this more. And that's kind of where it started. And we did some market testing that year and raised the first fund in 2019.
Okay. So, and sorry, I don't think I caught the name of the fund in the US that you mentioned.
Sorry, Tusk Ventures.
Tusk, yeah. Tusk.
Okay.
Yeah, Tusk. So they are in Bird Scooters. They're in Uber, Hims, which just went public via SPAC, Lemonade, InsurTech. So lots of really interesting regulated spaces.
talented people. And would you say that the whole focus of Tusk and Form, your pioneers of a new type of VC investing, or you know, have you seen more VCs join, or you know, the marketplace is growing?
So yeah, it's an interesting question, and I think the answer is probably slightly different in the US to Europe. So as liquidity is increasing, I just think there is more pressure on funds to sell themselves to the interesting startups. So I mean, it's healthy. Founders now get to choose when they're doing well which VC they want to get into bed with, and a VC, the focus is on the VC not just to be nice, supporting people, but also to actually offer something tangible. For some funds, that's just having deep pockets and saying, look, we can back you now, but we can also back you right the way through to IPO. And that is obviously a really material benefit. Yeah, so in the US, there's just been, because there's been that liquidity for longer, like there have been more funds that are differentiating in ways that means that they can win deals in the space that they really want to invest in. So I was saying Swill is a good example of a talent fund. Trust has followed Tusk, doing the same thing. You've got funds like Designer Fund, which just focuses on investing in startups where UX and UI are key differentiators. They have teams full of people who work at Snap, Instagram, like a lot of the best consumer startups where UX has really been the focus, or at least one of the competitive edges. And so that type of approach, which is, as we describe it as, when you've got lots of liquidity in the market, founders should think about building their cap table like they build their team. So think about the types of things you might want from your cap table and build your cap, and then build the investors around you in that way. So we're not saying we're going to displace like a generalist fund. Often generalist funds can play a really big role in helping a founder and their team and their journey towards, say, Series A. But for the markets that we invest in, we think we can add real value. It might not be immediately, but at some point between where you are and IPO, regulation or policy in these markets is going to really matter. And so having us to the cap table can really help.
So does that mean then that you look at specific sectors, and are there any sectors that you look to avoid as well as part of that strategy?
So we think of regulation and policy as a horizontal rather than a set of like vertical sectors. We think of it in three ways: hard regulated markets, soft regulated markets, and the regulatory frontier. So hard regulated markets we see as the traditional regulated markets, fintech, health tech. Usually there's a sector regulator. You often need a license to operate. Soft regulated markets are the traditionally unregulated markets, but there is often a set of regulations or policies that are really relevant to founders in that market. So a good example of this is gig models are often like working in markets which are largely unregulated, but labor laws, as we know, are really important as to whether they're going to be treated as companies or platforms that with contractors. So that's a good example of a soft regulated market. And thirdly, potentially most interestingly, is the regulatory frontier. And this is where either it's a completely new market, so crypto, lab-grown meat, where the regulatory framework is still developing because it's a new market. And so it's an absolutely existential issue for those startups in the market that the regulatory framework basically allows them to grow and get to maturity. Or there's a change in regulation that is giving birth to a market. So the best example of that we've seen in the last 10 years has been open banking. A lot of those third-party startups doing third-party payments or third-party analysis of your banking data, they just wouldn't exist without open banking. So we put those all in the regulatory frontier market. So those three buckets, arguably you could put pretty much any sector in one of those three, and that's deliberate. Like we take this regulatory and policy lens on the market, but ultimately our strategy is about how can we get into and then help the most interesting companies in the market. And so we invest across all three of those categories.
Do you invest in all three of those evenly, or?
So that's kind of, I'd say we've probably got more of a weighting to hard and frontier markets, and soft in the middle is because that's where pretty much any market sits. Fashion, e-commerce sits in the middle one because supply chain regulation is really important and lots of other kind of small pieces, but we're probably less interested in that middle sector. But but we don't have any targets. We just, if we see something as a good opportunity, then we will look to invest regardless of where it is across those three.
Okay. And has there been any change predicated by COVID, or last year, any particular notable focus shift because of COVID?
There hasn't been a change in focus from us. We think actually the markets we focus on in general have performed pretty well during COVID, because markets that are more heavily regulated tend to be the markets where government has made a decision to intervene in the market because that market matters to people. And government either needs to try to optimize outcomes for people or just protect people from certain business behavior. And those markets that matter, as we call them, they're often ones that, in a downturn or during a period like a pandemic, people aren't cutting spending on them. So digital health, that's obviously performed well over the last year for obvious reasons. But it's also true that, say, Organize, another startup we've invested in, which is essentially disrupting trade unions, or is allowing people to digitally take collective action. That's at a time when businesses are under a lot of pressure. That type of tool for employees has proven really helpful, and Organize with their user growth in the last year has gone up 10 times. So in general, we've just seen that markets that are more heavily regulated are often the ones that perform well over the last year.
Okay, great. So if we have a few founders that are listening to these wise words from you, Patrick, and they're thinking, and we naturally get this being consultants, that we're just starting, we're brand new, we've got an idea and we're going to build some tech, and we're going around all these different VCs and they say, oh yeah, fantastic, come back in 3 years. What's the sort of point that where do you get involved with different businesses? Is there a sort of minimum and a maximum amount of money that you invest, or or is there a group of companies that you have on a sort of your radar, and you like to talk to them and then hope that they get to a level that will be of more interest? I just wondered if you could frame the sort of more the mechanics of how you do your day-to-day job at Form.
Yeah, sure. So in general, the way we invest is we like to be the second or third biggest investor in a round. I mean, going back to what I was saying about our focused value add, we think we do best when we invest behind a big generalist fund, which is doing the broader kind of support for a founder, and then we can pick off a very specific area, which is our domain of expertise, and then add value there. For our fund 2, which we're hoping, fingers crossed, will close in Q2, we'll be investing 400k tickets at seed. That's our kind of sweet spot. But really, our approach is, it's never too early to talk to us. We're talking to a startup in Oxford at the moment that is doing something in deep tech, and they're probably, we won't invest in them for 6 months or a year, but we're interested in the area. Building a relationship is valuable, and we get to kind of understand, really get under the skin of the team. But we just want to get in at any point before Series A, really. Series A, we're reluctant to get involved in kind of the heat of the Series A competition and market in the UK, which, as we know, is growing growing interest from the US investors. So any point before Series A, we're willing to invest in. And 3 of our companies in our current fund have been pre-seed deals. So we can invest basically as early as pre-seed, but we do follow on as late as Series B.
And what's your current thought of the environment we're in? You alluded towards Series A being quite hot or very competitive. What's the sort of the pre-level that you're involved in at the moment? Is it also warming up?
Yeah, I think it is warming up, and it's usually it's the same story I think we've had over the last few years, that there are certain deals that are kind of closed deals, and they're not the deals that a lot of investors hear about. And then there are the deals that there's not necessarily the case that the closed deals are the ones that end up being the winners, but they often have repeat entrepreneur, or there's a reason basically why the round closes very quickly. The general liquidity is obviously very high, and so there is lots of competition for deals, and that kind of, the deals that are competitive, I think that pool is growing, which is great for founders. And fortunately, like the number of young people who seem to want to found companies rather than joining consulting or joining big tech, like that pool is clearly growing with the help of people like EF and Antler, who are obviously giving you kind of a nice pathway into doing it. And hopefully that culture of like, anyone can try and start a company. It might not necessarily be a VC-backed company, but it's still like a worthy thing to do. Hopefully that culture continues to grow, because if you look at startups per capita in the UK, we're still a long way behind like Israel. I know Israel is obviously one side of the spectrum, but that's what we should be aspiring to.
Yeah, I once heard a very funny analogy of about kids in Israel and kids in the UK, that most kids in the UK want to grow up and be David Beckham, whereas most kids in Israel want to grow up and have a startup by the time they're a teenager. So it's like slightly different mindset there.
Yeah.
But I'm curious to dig in a bit more on the sort of deal flow aspect, because you mentioned Antler, which is a great business, and EF, of course. With COVID, some of the changes that's predicated and forced us into changing the way we meet naturally. Have you seen a sort of slowing of deal flow purely because there's very few accelerators doing as much, and demo nights, and I suppose pitch evenings like we have at Notwicks, where people would always come along to, and as a sort of source of quality founders? What's your thoughts there, Patrick?
So I would say there has been a slowing. We'll obviously only know that when the kind of data comes through on like people starting up. Obviously there's been a bit of a bifurcation where some people during a hard time have thought, now's the time to start a business, and now's the time to take the risk. And there've been others who've just thought, yeah, it's time to hunker down. Like, I had that idea, but actually I've got this salary. Let's stick it out at the kind of corporate I'm currently working at. And I think in general, if you're trying to net those out, I think there's probably more people in the latter group who are thinking like it's time to play it safe when there's no end in sight to the pandemic. And so I would guess that there has been it has been reduced. Certainly, I think we have seen slightly less deal flow in the last year. And as you said, the lack of kind of in-person dynamism. Like, I'm a big fan of the new platforms that are taking, Zoom 2.0 and doing things like hop-in, like event spaces, or basically trying to replicate a lot of in-person working, but virtually. But I still think there's so far to go in that domain. And like, without the networking and the collisions, to use a bit of a cliche, that you get when you're kind of at these in-person events, I think things naturally do slow down a bit. And then, and that's quite separate. That's quite a separate point to the general risk aversion you get during a pandemic. I think it's quite natural. What I'm hoping for is that, we have a great British summer where things start to open up, and what the spirit's like around the Olympics and the Euros, that you could have a really positive summer, and that hopefully will translate into just people's risk appetite really growing again.
A coiled spring, as the Bank of England called it yesterday. I mean, one of the things that Chris kind of picked up on in the beginning of the pandemic, and we've been trying to bring a lot of attention to, is the effect that bottlenecking of deal flow and also people not starting up and the sort of pre-seed level will have on an increasingly competitive Series A market as well. So it'll be interesting to see what happens there.
Yeah, no, good point, Anthony. So, if we were to look a bit further out into 2021, Patrick, and, what's the big excitement that you have at Form? Are there a number of companies you're looking at, or, within the portfolio, are there some real stars forming? I just wondered if you could give us some sort of gems on the future with your crystal ball at the ready.
So kind of I suppose I'll answer like a broader question on the macro, and then like more specifically on what we're seeing in the market in terms of deals. I think on the macro side, what excites us is that government's appetite to, not necessarily appetite to regulate more, but to take technology seriously as a driver for improving people's well-being. Like that is just being acknowledged as like by most governments around the world as something they should be taking really, really seriously. And a couple of years ago when we started, frankly, when we talked about regulation of technology, a lot of people looked at us like, "What is that even a thing? Like, why would you kind of care about that?" And governments, you know, and partially due to COVID, like governments have realized actually a lot of the tech solutions are like what they should be turning to kind of protect people over this period. And that kind of appetite and interest from government we see as an area of opportunity, like especially in the UK, like whatever you felt about Brexit, repatriating powers from Brussels to London has made London the only city in the Western world where the startup ecosystem and all is based and all the policy is being built. And that hopefully we can see that as an opportunity where we can have more collaboration between regulators, government and the startup ecosystem. And ultimately that would drive forward our startup market. So that's the kind of hope for 2021 and going forward.
Especially if you look at in the EU, where they're bringing more and more antitrust cases for tech, and they've even put it as a line item in their budget.
Okay. Yeah, that's interesting. I mean, that is certainly creating some waves. Yeah, and it'll be interesting to see how UK, whether they like follow suit or whether, you know, that's this regulation of tech is an area where we'll try to slightly plow our own furrow. I think in areas we definitely will be, I think the UK will be looking to slightly gain a bit of an edge in the startup ecosystem by taking a slightly different route. So yeah, watch this space. On the specifics, I mean, what do we think is interesting? You know, in our own portfolio, there are a couple of startups that have been doing really well in the last year. Well, several, but in particular, I mentioned Organize, they've done really, really well. We think no one else is trying to tackle that space. And that's partially because you need the right founders to build a business, which is about basically supporting people who want to take collective action or collaborate in the workplace. In that way, you need the right founders, and Bex and Nat, the two founders of that company, are just the right founders with the kind of campaigning pedigree to build that company. Another is Peppy. So Peppy is started with just menopause support, but it's really supporting employees at a company go through key life transitions, which they've gone into menopause, fertility, and new parenthood. Obviously, again, with digital health being a real focus over the last year, Peppy have done extremely well. Menopause support in a lot of corporates is just, you know, so far behind the curve. I mean, it basically doesn't exist in lots of workplaces. And Peppy's pretty much one of the only company, or is the only company that's kind of got to the stage. There are quite a few fast followers now. You know, going through the B2B to C channel or B2B to E channel, which is often, you know, hard to do. Lots of people trying to sell into that benefits channel, but they're doing really, really well. Yeah, so I definitely, I think Peppy for 2021 is one to watch.
Okay, great. And then on the aspect of, I suppose, valuation, I'm always kind of intrigued. It's a key topic of conversation for you with many founders. What's the current thought process when it comes to valuation when you look at some of these new businesses that are coming to you?
Yeah, it's interesting. I mean, there seems to be a bit of a divide, isn't there, between people that are price sensitive and those that pretty much aren't price sensitive. And I think there's something to be, there is a degree of truth to, you know, you pay what the founder asks. When it seems to be a company that you really believe might be the outlier, you will kick yourself if you pass on price if it ends up being Uber. I mean, that's always true. The degree to which you allow that to determine your pricing policy is obviously, that's where I think there's a bit more debate, because if you, hopefully you believe every company you invest in could be an outlier. If you're completely price insensitive and you end up paying twice the price for all those companies, your portfolio ends up being half as large and you don't have the diversification. So like even people who say they're not price sensitive, like there are limits to that. And I think really, I think that what most, obviously there are methodologies that some VCs claim to use. I think the the one that people really use most is comparators, and just looking at other deals in the market and saying, you know, oh, well, you are a founder who's exited 2 companies before, you've built a unicorn before, there's no wonder you're raising at 20 million. Or you know, Y Combinator startups, apparently it's quite standard for them to raise pretty quickly at $20 million, like pre-money valuation. That's pretty rare in the UK. I find like in the UK, actually, if it's seed, if it's 5 money or 4 or 5 pre through to 10 pre, that's like quite a standard range. If it's above 10 pre, then usually there's something about the founder. Either they've got very good pre-seed investors, which has kind of anointed that startup as being like particularly interesting, or that team have got like particular pedigree. The kind of counter to that slightly is, and I saw people talking about this on Twitter the other day, that there are several kind of fintech markets or market opportunities that are that will genuinely give birth to $10 billion plus companies. And if you do like, you know, an attempt at discounted cash flow or risk adjustment to that, you will end up with a larger valuation than say an opportunity that's only a $1 billion opportunity. And I think that's a fair point. I think I saw that there was a podcast with First Round, someone from First Round Capital, who said they tried to look at whether there was any correlation between the outcomes they expected from the companies they invested in and the actual outcomes when they became successful. i.e., like if you looked at all of your companies and said, okay, if they were all unicorns, how big do you think they would get? And they looked at that data and they said there was pretty much no correlation, which I think is interesting.
That's interesting.
That suggests like you shouldn't adjust too much for like, oh, well, I think this could be a $5 billion company or a $3 billion company. Actually, like you should just think, does it have the opportunity or capability to be a huge company? Yes or no? And
so they were trying to put a terminal valuation on it for when they had the liquidity event, and found that, you know, they could miss it by a country mile. And there still isn't, if you look at a lot of the, you know, the big success stories and big public failures at the same time, there still doesn't seem to be a lot of rhyme or reason to it. If you look at, you know, the WeWork market event that happened, but then you compare it with Snowflake and Airbnb, right, which both, you know, blew the doors off it. There still doesn't really seem to be, you know, a rule there. Yeah, exactly. And I think another interesting comment I heard recently was that the last double in valuation for a VC is much more important than the first double. And it did make me think, like, it's true, it's not something people often talk about, but those going from like 2 billion valuation to 4 billion valuation, that's what turns like a good fund into an outstanding fund. Whereas early on, which is when a lot of people are focusing their time thinking about like the first double or the first, you know, whether it's an 8 million valuation or 16 million valuation, it's like, well, it's not that focus of getting the early markups is kind of by the by, unless you get the late doubles in your portfolio. I think the other aspect that's going to kind of change things in the future is what those exit opportunities are. And, you know, this is something that Chris picked up on, I think last week, sent me an article about SPACs coming to the UK as well, right? Giving a much easier route to market to do an IPO rather than just a trade sale or out to private equity, right? Which often you don't get those crazy valuations that you do, you know, and if you look at the US, a lot of it is IPO based.
Yeah, it'll be interesting to see how much the SPACs do cross the Atlantic into the UK, because some of the people, it's really interesting. And I mean, clearly it's highlighting, if nothing else, it highlights that the general IPO market, a bit like direct listings, you know, they exposed that there was something that wasn't working quite right with the IPO market. Are SPACs the kind of permanent long-term answer? I doubt it. I just think they've probably just exposed that the IPO market is not functioning properly. And I think we'll see, and years ahead we'll look back and say like, oh, some SPACs worked really well, but others were a disaster. They were so buzzy. Yeah.
Interesting. So on the topic of funding, you mentioned earlier, Patrick, that you're about to, or hopefully going to close Fund 2 in the spring. I think you mentioned. What's that marketplace like? What's the current climate in, you know, going out to raise Fund 2? Was it like a stroll in the park, or, you know, still as hard as when you went out and raised the first fund? Because obviously I imagine, as you have proved yourself quite effectively with Fund 1, do people just like go, yeah, more, we'll give you more, we'll give you more, you know, just if you could paint a picture there, that would be brilliant.
Yeah, so I guess, I mean, unfortunately, the answer is just as hard, if not harder. And that's mainly because the group of LPs or our investors that we've gone to are in general a different set. Because our first fund was like sufficiently small that we could go to, we had 30 LPs, mainly individuals, and we could take, you know, check sizes that were quite small. So we reached out to people basically who understood the thesis, you know, generally didn't know us directly, but 1 degree of separation away from us, and 1 or 2 degrees of separation away from us, and they had the liquidity to invest in. Basically, they were investing in startups, and they saw us in a similar way as like a startup fund. Now, the second fund is 30 million, and so you can't really get hundreds of like smaller checks. You have to go to family offices, kind of ultra high net worth individuals, and fund of funds that look at emerging managers. Now, unfortunately, the track record you can build in the kind of 2 years we've been running is naturally quite limited. You know, funds, as I'm sure everyone knows, generally are 10 years in length or sometimes longer. And we can't prove, you know, unfortunately, none of the investments we've made have yet returned any money. Neither would we expect them to. And so we still really just have a pitch deck. We've done more, we've executed, but the people who we are trying to raise money from, they just, you know, the bar is that much higher than it was with the first fund. And often they're professional investors who they're comparing you against a seed fund that's been around for 10 years. So even those who say they invest in emerging managers, often when you really dig deeper into like what they mean by emerging manager, they actually use this kind of strict definition of fund 1, 2, or 3, with a clear bias towards you being a later fund. And then on top of that, there's just a general difficulty with finding LPs. It doesn't have the transparency of the VC market, where you can kind of look up online who are the VCs we should be speaking to, and then helpfully there've been Medium posts with all of the seed funds in London. It doesn't really work like that with LPs, unfortunately. So
I'm sure they try to keep those, you know, the other VCs are trying to keep their cards close to their chest as well, aren't they?
In general, that is true. There are some like exceptions who hopefully one day we'll be giving like great thanks to, who have been immensely helpful in pointing out LPs and telling us, you know, oh, these people actually invest in funds. You wouldn't know from their website, but actually they are LPs.
So would you say in the next 6 to 12 months, we probably won't see too many new fund launches?
Well, I should mention that the British Business Bank, who, when you look at the amount of LP capital they account for in the UK, they are by far the most like influential LP in UK venture. They have pretty good, rigorous process. And I say pretty good, it's really good. I mean, they are responsible for us basically putting Fund 1 together through their support or advice. They, I think, are at a cadence of about 3 or 4 funds a year. So I expect that will continue. So we will see new funds. I mean, they're not just very early stage venture funds. They do like a range of different type of venture funds. So I expect that will continue. And I do think raising without them, unless you are spin out from an existing VC, raising without the British Business Bank is particularly hard. And that's one of the main reasons why we don't have so much, and why we are further behind the US in terms of venture innovation, is that if you can only raise from the BBB, which is a very long, rigorous process, which requires you to make money through other means. So Leo and I had second jobs. So either that's one avenue, which is obviously very hard, or you have to be an existing GP or existing investor at a VC, which means if you spin out, you're very likely to do what you were doing before. In which case, like, room for innovation is obviously limited if you can only take one of those 2 tracks. And I think, you know, hopefully we get fund of funds with a higher risk appetite who are genuinely willing to do those really early emerging managers who are doing something different and genuinely innovative, because that's what's going to will drive diversity, it will drive innovation, and then ultimately that would be best for the ecosystem.
So entrepreneurs listening, if you thought it was difficult to raise money from a VC, imagine trying to raise money for a VC.
Yeah, I kind of get limited sympathy for saying for saying that to founders. I think understandably, I think once you've raised the fund, obviously you have secure income, but before then we do say, well, we don't, we have very limited, if any, income.
So with the obviously the focus on the the regulated markets, etc. Are you looking purely at UK businesses, or are you investing all over Europe, Patrick?
So the vision is very much to be the de facto regulated market VC in Europe. But for now, the fund is just investing in UK startups. So I think it will be Fund 3 maybe. Like the plan at the moment is to at least be in Paris as well as London by Fund 3. France being, after London, I think the biggest engine of startup activity in Europe. And we want to be able to help founders who are, say, in the UK and they want to expand into France. The regulatory and policy issues are some of the biggest issues that they face in expanding, and we would love to be able to help a founder do that. So that's the dream, but at the moment it's just UK focused.
Interesting comments about Paris there, Patrick. I'm curious, a number of the VCs we've talked to are longing to go back to that physical office, be it London, Paris, wherever. What's your thought process on future working? Will you all go back to the office 5 days a week, 1 day a week? Just what do you think it's going to look like? And I suppose in a way, what are you missing?
So I mean, definitely missing in-person human interaction. When occasionally I've been on a walk with my wife and baby and we bumped into a friend in the park, you realize how different it is speaking to people in person. So used to speaking to people on video calls, and it's just so much more natural. At least for me, it's so much more natural. And I feel like it's so much more productive. But I mean, I'm a big believer that we'll eventually we'll get to a hybrid way of working where we recognize that there is value to being in person. A lot of networking and biz dev, which is essentially the engine of most businesses, needs to be in person. We definitely building relationships, which is obviously key for fundraising, is just so much more difficult online. I was talking to a VC the other day who said they have twice as many conversations with founders that they're looking to invest in now that everything's online, which I thought was interesting. And that probably reflects actually what we're doing. We're doing
twice as many.
Yeah.
Okay, that's interesting.
And I'm sure that's reflected in most funds. It might not be twice as many, but certainly more meetings to build trust and build that relationship. So there is value to in-person work, but equally, I think moving back to a full-time in the office is just, that doesn't reflect. I think what we've definitely learned is that there's lots of work that we can be doing remotely, and we do not need to be making a commute or spending time in an office sitting with other people to do that work, and it can be more productive to do it at home. So I'm sure where we'll end up is like a hybrid way of working, and I think that's what we'll be doing at Form. The current plan is that the two of us, and when we build a team for Fund 2, the extended team will expect everyone to be in London, say on Tuesday, Wednesday, Thursday, but work from where you want on a Monday and Friday, and that is just a permanent policy. And I think a lot of businesses will end up in the same place. It'll be interesting to see where like the general economy that serves the kind of 9-to-5 workers, trains, real estate, restaurants, like coffee shops, how will they adapt to that new reality? Because I'm sure it's neither extreme will be true. Like not everyone's going to go back to work in 9 to 5 days a week, nor are we going to move to this kind of weird dystopian like London being empty and no one.
I think that there's Patrick. I certainly think there's a real opportunity for sort of localization of businesses and the sort of growth of the local work hub as provided by your employer, maybe membership system, for some of these spaces that are becoming available. We live in southwest London, and our high street has got somewhat of an increase in vacant space because of what's happened with COVID. So I'm sure it will come good. So interesting times ahead. And then, I always ask this question. You've met a lot of founders. Have you ever kind of you know, being in that situation where you're thinking, oh my God, what's going on here? This meeting is really gone not the way that we expected it to go, and there's been some real howlers in that meeting. I'm just curious on your you know, what are your tips for founders when you're engaging with people?
Yeah, good question. I mean, the answer is definitely yes. We've had those meetings, but that reflects mainly that we've met lots and lots and lots of founders, rather than that founders have any particularly a set of people that act like inappropriately. Obviously, I'd say the most important tip, and this might be a bit unhelpful, but the most important tip I'd say is to be honest. And I say that's unhelpful because I completely understand, given that we are fundraising, I understand that you have to tread a really careful line between like overselling and underselling. But you need to make the best representation of yourself, and ultimately you want to get those investors on board. But the price of dishonesty is very, very high. So as soon as, like, in general, once you take on someone's money, either during the diligence process, in which VCs tend to go pretty deep and will often find out if you're being dishonest, or once you have taken the money, like if you're successful, you're going to be working with that VC for potentially 8 to 10 years. Fingers crossed you will be. And if you've kind of undermined that relationship from the start by basically lying or like exaggerating the truth too much, it's just, you're really shooting yourself in the foot. And that's probably something obviously different VCs will be sensitive to that in different ways, but I find like just sometimes it's just really sabotages the relationship before it gets started. And I think if people do find that out during diligence, it's really hard to salvage a relationship there and get people over the line. It's equally hard to salvage a relationship once even they are investors and they find out actually things weren't exactly as you said. So
you definitely lose the benefit of the doubt, which is a high price to pay for over exaggerating, as you put it.
Yeah.
So slipping it around the other way, you know, you talked a bit about the life of a VC earlier and how, you know, different, you know, the industry is attracting more individuals who would have traditionally have gone into, you know, banking or finance or other areas of finance. Just, you know, what is the nuts and bolts of the job, and is it as glamorous as people make out it is? You know, there's several articles in the press that VC partners are like the new hedge fund rock stars of this generation. I'm just kind of curious, what's the real deal?
So I guess, I mean, maybe I've got a bit of a skewed view of this because we've tried to do a startup fund, which obviously does have elements of the job which a lot of more junior people in funds probably don't get involved in. Not necessarily the sexier parts of the job, just the, as you described it, the nuts and bolts of venture, which you probably only do when you're actually trying to manage the fund at the top. I'd say on the plus side, it is, if you are a really curious person and you love to talk about like different ideas, try to very quickly get under the skin of an idea and then work out whether you should be making an investment or not. That type of curiosity is brilliant for that type of mind, and I do love that side of the job. At the same time, I would say one of the best answers I've heard to this before is a VC who said, when people ask me what venture is really about, I say it's about two things. One, sales, because you are always selling. You're selling to LPs, you're selling to founders to take your money. You are constantly in sales mode. And the second is money management. Ultimately, you are managing people's money and you are allocating that money across a set of assets to try to optimize returns. And if you need to go into venture, like acknowledging that those two are the key components of doing well in venture. Now, it's not my point about you being exposed to different sides of venture and different roles, is that with associates, like junior grades, I think you're maybe less likely to have to get involved in the kind of the nitty gritty of the money management, i.e. like looking at portfolio construction and like follow-on strategy, which if you're into like the mathematical side, which Leo and I are, then that could be fun, but it's not really how associate VCs are sold the role. And equally with the sales, like you might not have to do so much sales as a junior VC, like maybe you wheel out the GP who's really good at closing a deal. But ultimately, I think, if you go up through a VC fund, you end up doing more of the sales and more of the money management. So yeah, so the answer is, I suppose, mixed. I mean, as always, it's not as glamorous as most people think it is. It just seems to be the hot job, one of the hot jobs at the moment, in the same way as consulting was in the noughties, and maybe big tech has been for the last few years. So yeah, mixed answer.
It's great to see you speak so passionately about what you do. It's always impresses me. I think all of the VCs we've had on have always been really, you can see the energy they have and the passion they have for the job, which is great. And, you know, puts us in a good place, hopefully, as we create the next 10 years of great British and European tech companies. So keep it going. Hopefully. So we're coming near to the end of the call, Patrick, and it's been really, really insightful. And thank you for all your great answers. I think you mentioned a baby earlier in the call. I'm just conscious of what, you know, do you have any time outside of form and a baby to do other things? You know, is there a mysterious hobby that you have that you'd like to tell us about, and what do you do in your spare time? So
yeah, besides baby Felix and expecting a second baby,
congratulations.
So that takes a lot of my time. Thank you. I try to read fiction to escape, which is, usually you ask VCs like what they're reading and they say like, oh, the latest business book. And while I try to read those occasionally, I just need to escape the job occasionally. And so I read fiction. But to make one recommendation there, I think The Nickel Boys by Colson Whitehead, which it's just a fantastic book. And there's a follow-up to a book called Underground Railroad. So both of those books are brilliant, and I would recommend people read them.
I think my laptop beeped as you said the name of the author there, Patrick. Could you just tell us again?
It's Colson Whitehead.
Okay, that's an interesting name. And is it UK novel, or where's it based?
No, it's a US author. He is the first author to win the Pulitzer Prize for fiction twice since Faulkner, I think. He's brilliant. So I'm not alone in recommending it. Unfortunately,
okay.
It's not very.
I really am showing myself up on the reading front by not knowing that clearly, and Anthony's laughing in the background. So there you go.
Don't worry, I don't read much either.
Okay. And partly, you know, the reason why I probably don't read as much is the fact that we tend to be quite streamed to with our various Netflix and Amazon shows that we've become Family Low has become very into over the course of lockdown, especially. I'm just also curious, are there any tips on the viewing side from Patrick? What you're watching at the moment on the telly?
Yeah. So I actually think that has been a drying up of like really high quality content, and maybe that's because stuff hasn't been made for the last year. The two things that I've watched maybe in the last 12, 18 months that I think are really, like, there's lots of, I think Netflix obviously produces lots of good content. So does Amazon, but the standout shows for me are Chernobyl. I think Chernobyl is just
on HBO, right?
Yeah. And it's like a stranger than fiction story. Like, you can't believe it. And just so well produced. I really think that's brilliant. And the people I know, a couple of friends of ours are from Kiev, and they just say it, like, they remarked on how good it was, which I think was a really, like, you know, a sign of how accurately it had been produced. And the second, and probably more relevant to what we're discussing, is Succession. So Succession, which I just thought is a brilliant, like, mixture of genres. And obviously, if you try to forget that it's loosely based on the Murdoch family, you'd probably enjoy it more. I really think Succession is great.
Have you watched Snowpiercer at all?
No, is it? I think I saw the film, but there was a film and now there's a show, is that right?
Yeah, it's really good. If neither of you have watched it, I highly recommend Snowpiercer.
Really?
There's 2 seasons now. They're still rolling out season 2, but it's really good.
And what's the general gist of that, Anthony?
Post-apocalyptic world where it's snowing. The whole globe is just covered in ice. but there's a train that is making a route around the world, and if it drops below a certain speed, everybody dies. But all of human society is encapsulated on this train, and it has different classes. So it's no surprise that one of the main characters from Hamilton is a revolutionary from the back of the train, and I'll leave it there.
Oh, cool.
Great.
Yeah.
Okay, that's the weekend viewing sorted. Thank you for that. And look, Patrick, I want to say one big thank you again for taking your time today in the glorious sunshine that you have coming into your room. And stay well. We look forward to keeping in touch over the course of 2021, and wish you the very best of success at Form, because it looks like it's a big year ahead for you. So congratulations on everything, and well done, and we will be in touch soon.
No, sure. Well, thanks both for having me on, and thanks for all your support, because you're always really useful and valuable friends to us at Form.